What's going on, guys? It's Hayden. I hope you're having a good day so far. And today we're going to be talking about ways that you can profit if there's a potential recession in 2023. A recession next year is definitely not guaranteed, but the reason that there are conversations going on about that right now is because the Fed has raised interest rates so much to try to deal with inflation. And the worry is that this high interest rate environment is going to lower borrowing, spending, and thus demand. And that's essentially going to make our economy shrink. I went a lot more in depth on this topic in my other video called Housing Market Crash Incoming. So if you haven't seen that video, make sure to check it out. I'll put a link to it down in the description. So the number one mistake that many investors make during times of a recession is that they become more conservative when you should actually become more aggressive, because the potential returns that you can get are much higher. The reason for this is because markets such as the stock market are forward-looking, meaning that prices today are based on what people think is going to happen in the future. And so by the time we realize that we're officially in a recession, the markets will have already taken that into account and gone down a lot, and will probably be a lot closer to the bottom than people may think. So we're going to go through 4 things that you can potentially do during a recession that will allow you to make the most return possible. Number 1 is going to be to invest in a stock fund or ETF. And if you're not sure what that is or how it works, I mentioned that a lot in my other video called Stock Market ETF to Buy Right Now. So if you haven't seen that video either, check that one out as well. I'll put a link to that in the description too. But when you buy an ETF, you're essentially wagering on the return of the economy as a whole, as opposed to the recovery of individual companies. And I'm going to show you a chart right now to show you why you should bet on the recovery of the economy as a whole. Okay, so there are 3 important things to look at on this chart. Number 1 is the economic event down at the bottom. And as you can see, these are some of the worst events that our economy has ever experienced, such as the Great Depression, post-World War II, Cold War jitters, Vietnam War, the dot-com bubble, the global financial crisis, and the COVID-19 pandemic. The red bar above the event shows the stock market return at its low during that time, and then the 3 bars above it are the return over 1 year, 5 years, and 10 years. So as you can see, one that everyone knows is the Great Depression in 1930, where the market was down 83% at the worst point, and then it went on to recover 121% in 1 year, 263% in 5 years, and 86% over 10 years. And as you can see, the story is basically the same for all of these. The most recent one that we have all the data for is the financial crisis in 08, where the market was down 57%, and then it went on to recover 69%, 177%, and 311% over the next 10 years. And just to give you some perspective, this year, the low point of the market was minus 25%. So it's not even as bad as any of these historical ones on the screen. So the reason I showed you that is to show you that every single time in history when the market has had a crash or a downturn, it has recovered literally every single time. And no matter what the market does this last month of 2022, no matter what the market does next year or the year after, we're basically guaranteed to have a big comeback at some point. We just don't know when it is. So the way to buy into a stock fund or ETF to prepare for that stock market comeback is to DCA, or dollar cost average. And dollar cost averaging is when you put in a consistent amount of money on a consistent time basis. So an example of that would be putting in $1,000 a month on the first of every month. The reason you want to do this is because you end up getting into the market at an average price of all of the fluctuations over your investing period. And so you get a higher return doing that than trying to save up a lump sum and then guess where the bottom of the market is, because realistically it's impossible to know when the bottom is. The second thing you could do is invest in a dividend stock fund, which is essentially the same thing as a regular stock fund, but it focuses on mature companies that pay a dividend all of the time regardless of the economic situation. And the reason you might want to have some of your money in one of these is because it's a little more conservative than a regular ETF, because even during the market downturn, you're still going to be getting those dividends and the cash flows. And so you're not going to have to wait for the market to recover to get your return through capital gains. My number 3 recommendation is a high yield savings account, but this is only for special and strategic purposes. So inflation is so high right now at 8 to 9% that holding a lot of cash for a long period of time is not a good idea, because your cash is essentially losing 8 to 9% of its value per year. But a high yield savings account could be a good idea if you're saving to make a big purchase in the near future, such as the next 6 months. And I would say the biggest example of this would be a down payment on a house. And the reason you wouldn't want to put your down payment on a house money in the stock market is because there's no guarantee that in 6 months the market will be higher than it is today. And you wouldn't want to have to pull your money out of the market lower than it was when you put it in, because you need the money for the house. So a high yield savings account is going to be a lower return over the long term, but at least you're going to get a consistent return until you need that money. Now we're going to switch gears and talk about 3 things that you should not do during the 2023 recession. Number 1 is going to be to buy real estate, which is weird because under normal circumstances where we could be going into recession, the expectation would be for the Fed to lower interest rates, such as what they did in 2020, to kind of stimulate demand and prevent the recession. But right now, the Fed's raising interest rates because they're focused on inflation. So that has made mortgage rates really high. And also the prices of real estate are just really high in general right now. So I would say this is not near as good of an investment as it would normally be. The number 2 thing not to do is buy bonds. And the reason for that is because bonds are a good investment going into a recession, but not during one. Bonds are good to purchase when interest rates are expected to go down in the future. And the Fed has already said that they're planning to keep raising rates until inflation has been dealt with. And so the prices of bonds will most likely keep going lower until that happens. Also, as I showed you earlier, the stock market is going to have a huge comeback at some point. And so if a lot of your money is in bonds, bonds are not going to get near the return and the recovery that the stock market is. And so all your money that's in bonds is just going to miss out on that massive recovery. And then the last thing that you should not do, which is the hardest one by far, is do not get emotional about seeing your investments go down. Seeing your account lose value creates a negative feeling. And a lot of the time it makes people feel like they need to do something about it. But in reality, there's nothing you should do except just keep following your long-term investing plan. If seeing your investments go down does cause you a lot of stress, there's a few things that you can do to kind of deal with that. And the first thing is have an emergency fund. An emergency fund is just a savings account with a few months worth of expenses in there. And the reason that will help is because being financially secure during a recession will make it much easier to deal with that stress with your investments going down. An emergency fund is definitely something I'll talk about a lot more in a future video. Another thing you can do is just stop checking the stock market so much. The market's going to do the same thing whether you look at it or not. And so if it causes you a lot of stress when you look at it, just look at it less often. Maybe look at it once a week or once a month. Personally, I always check the market because I like to follow it and know what it's doing. And I don't really have emotions attached to it anymore because I've been following it so long and I know how it works. Just remember that there are more good years than bad. Historically, 3 out of every 4 years the market is positive, and only 1 out of 4 years the market is negative. So just keep that in mind. And then my last piece of advice is when you are in doubt, just keep investing money. I have never ever heard of anyone who kept investing money during a market downturn that ended up regretting it. We don't know when it's going to happen, but we know that the market will recover and there will be big returns to be had. So just keep that in mind and keep investing. I tried to keep this video as short as possible, so that's all I've got. If you enjoyed, don't forget to like, comment, subscribe, turn on post notifications so you don't miss a video. Keep an eye out for an announcement either late this week or next week, and I will see you guys in the next video. Peace out.